Welcome to part 2 in my two-part short series on lessons from an investing legend called Warren Buffett. Now, 2025 has been a big year for fans of the Sage of Omaha, as he was known. He's no longer CEO of Berkshire Hathaway, the company he founded with his partner Charlie Munger, having spent 60 years generating average annual returns of 20%, which sounds impressive, and it is because it's substantially above the equivalent average annual return from the S&P 500, that wide index of American share prices. So how did he do it, and which bits can we copy? Well, in part one was a bit depressing because it's kind of, there are things about Warren Buffett or being Warren Buffett which are pretty hard for most of us, including me, to replicate. So in part 2, how can we be more like Warren Buffett? What are some of the lessons that we can take away that will actually potentially enhance what we make from our own portfolios? And I would say there are three. There are more than three, but three big ones are: he was incredibly patient, he believed in dividend reinvestment, and he had the right mindset to make sure both of those two things worked for him. So patience. Buffett was famous for his aphorisms and expressions and phrases, but one of them was the stock market is an incredibly efficient way to transfer wealth from the impatient to the patient. And what he meant was you have to be in it to win it. Time in the market, the effect of compounding over decades, 60 years, is incredibly powerful, all right? And therefore it's super important that you don't dip in and out of stocks, cash in too early. And it's worth noting, the way that compounding works is that you get a big kicker the longer you wait. It's just a function of the maths. So over that 60-year career, an awful lot of his gains came in the last 10 to 20, okay? And that's just a function of being patient. Now, what structure did he use to enable him to be patient as an investor with stakeholders to account to? And the answer is an investment trust. Now, investment trusts I talk about elsewhere, but they allowed him not to come under selling pressure in the same way he would have done potentially if he got a rush for the exit from something like a unit trust. So his fund was structured to allow him to ride out volatility, and that's something, without going into the technical detail of investment trusts, you can do too. You are not under the quarterly pressure that professional fund managers face to justify their existence. Why haven't you hit the benchmark, Tim? Why aren't you above the benchmark? All right, as a retail investor, you can choose to be patient. You can choose to spend time in the market. You don't have to liquidate stuff in order to prove your worth to yourself, okay? Number 2, dividend reinvestment. Now, I've covered this before, but essentially, when a company pays a dividend, you've got two choices. You can either just take it out like a cash point machine and spend it there and then, or Buffett would say, given you're in it for the long term, given you are patient, why not reinvest it? And what you're reinvesting in is more shares in the same company. And there are mechanisms, stockbrokers have them, they're very common, to allow you to mechanically reinvest dividends that come through. And if you think, why would I do that? Well, a number of studies, Barclays have done a good one, for example, have shown that since 1925, for argument's sake, so going back a century, if you want to see it that way, 50% of your cumulative total return from stocks would have come from the compounded power of those reinvested dividends, especially if you're Warren Buffett and you let them compound over decades, all right? So that's lesson number 2. Don't spend dividends, think about reinvesting them. And number 3 is you need the right mindset. Now, I've covered the mindset of an investor in other videos, but I want to pull out a few points here directly relevant to things that Warren Buffett did. He was a big believer in keeping investing simple. He did say it's not easy, otherwise we'd all be multimillionaires if you like, but he did say the approach should be relatively simple. So, diversify, yeah, but don't overdo it. You don't need hundreds of stocks in a portfolio. Around 30, if you follow the capital asset pricing model, will eliminate the vast majority of your single stock risk. That's the risk that one stock brings down the whole portfolio. Keep low costs and churn down. All right, so in other words, don't overpay. Identify good firms, all right, pay the right price for them, keep your costs low if you can, and then stick with them. That's a kind of Terry Smith version of Warren Buffett's mindset, all right? And if you're thinking, what's a good firm? Buffett was a big believer in certain key principles. They must have decent moats, a decent competitive advantage over their peers, and that needs to be sustainable in brand terms, in innovation terms. There needs to be something about them that makes them interesting and unique and difficult to copy. Strong balance sheets for Warren Buffett were a must. All right. In other words, you need asset backing, and he was famous for buying firms with that kind of asset backing, railroads towards the end of his career and so on. And cash flow needs to be positive, consistent, and predictable, and in some way map to the profitability of the business. So if a business is claiming it makes £1 of profits, is it turning that into something like £1 of cash flow? All right. So, message from this video. There are 3 ways: patience, dividend, reinvestment, and the right mindset, where, no, you can't be Warren Buffett. There will only ever be one Warren Buffett, but you can certainly be more like him as a retail investor. And on that note, I'll just reference the usual 3 sources for more information. Killick.com/resources. I think you've heard this before. Killick Explains videos are there. My guides are there, including the How to Invest in Equities guide, and also the latest copy of our quarterly flagship magazine, Confidant.